Imagine announcing that your company is about to spend $20 billion without expecting to earn meaningful returns for several years. Most investors would probably ask one question: why? Yet that's exactly what's happening across corporate America. Technology giants are building enormous data centers. Chip manufacturers are constructing new fabrication plants. Energy companies are expanding power infrastructure. Cloud providers are buying land years before they need it. Manufacturers are investing in entirely new production facilities. Collectively, these projects represent hundreds of billions of dollars in spending. What's surprising isn't just the amount of money. It's that many of these investments won't generate significant revenue immediately. In some cases, companies know they'll have to wait years before seeing meaningful returns. So why are businesses willing to spend so much before making a single dollar? The answer reveals one of the biggest shifts happening in the American economy today. Here's why. For decades, business expansion followed a familiar pattern. A company would launch a successful product. Revenue would grow, profits would increase, then management would reinvest part of those profits into expansion. Growth funded more growth. It was a relatively predictable cycle. Today, that cycle has changed. Many of the opportunities businesses are chasing require enormous investments long before customers ever begin paying for the final product. Take data centers. Before a company can offer cloud services or run advanced AI systems, it first needs massive computing infrastructure. That means purchasing land, constructing specialized buildings, installing thousands of servers, building advanced cooling systems, connecting high-speed fiber networks, securing reliable electricity, hiring engineers and technicians. Every step costs money, lots of it, and none of it immediately generates revenue. The same pattern appears in semiconductor manufacturing. Building one advanced chip factory can cost tens of billions of dollars. Construction often takes several years. Production equipment is among the most sophisticated machinery ever created. Workers require specialized training. Only after everything is complete can chips begin rolling off the production line. Revenue comes later. Investment comes first. Energy tells a similar story. America's growing demand for artificial intelligence and cloud computing requires enormous amounts of electricity. Utilities aren't waiting until the power shortage happens. They're expanding transmission networks, building new generation capacity, modernizing substations, strengthening the electrical grid. These projects also take years. If companies wait until demand overwhelms existing infrastructure, they're already too late. That's why investment happens first. Revenue follows later. At first glance, this seems risky. Why spend billions without knowing exactly how much demand will exist several years from now? Because history suggests waiting often becomes even more expensive. Think about the internet. Companies that built digital infrastructure before online shopping became mainstream eventually found themselves in a strong position. Businesses that delayed often spent years trying to catch up. The same thing happened with cloud computing. Organizations that invested early developed expertise, attracted customers, and expanded their platforms while competitors were still deciding whether cloud services would become important. Today, few businesses question that decision. The same lesson is shaping corporate strategy now. Executives increasingly believe the companies building tomorrow's infrastructure today will have significant advantages once demand reaches full scale. That's why investment is accelerating. Another reason businesses spend so early is because modern infrastructure can't be built overnight. A new office building may take months. A cutting-edge semiconductor factory can take years. A major data center requires enormous planning, specialized equipment, and reliable power. Expanding the electrical grid involves permits, environmental reviews, engineering, and construction. Every delay pushes future revenue further away. That's why companies often begin projects years before they actually need the capacity. They're buying time as much as they're buying infrastructure. Competition also plays a major role. Imagine two businesses entering the same market. One waits until customer demand becomes obvious before investing. The other builds infrastructure years in advance. When demand finally arrives, the second company is ready immediately. The first company still has years of construction ahead. That difference can determine who captures the largest share of the market. Executives understand this. In fast-moving industries, preparation often matters just as much as innovation. Artificial intelligence has made this even more important. Training advanced AI systems requires enormous computing resources. Running AI applications for millions of users requires even more. Businesses know that demand for computing power is increasing rapidly. Rather than waiting for shortages to become severe, many companies are expanding capacity now. It's a long-term strategy built around future demand rather than current revenue. Wall Street has noticed investors increasingly pay close attention to capital expenditures. Large spending announcements once raised concerns about shrinking profits. Today, they often spark different questions. What future opportunity does management see? What demand are they preparing for? Which competitive advantage are they trying to build? That's because markets understand that infrastructure spending frequently signals confidence in long-term growth. Of course, these investments aren't guaranteed to succeed. Some projects will cost more than expected. Some technologies will evolve differently. Some facilities may take longer to become profitable. Every major investment carries uncertainty. But executives also recognize another reality. Missing the next wave of growth can be even more expensive. History is filled with companies that waited too long, businesses that underestimated e-commerce, companies that ignored smartphones, organizations that delayed digital transformation. Many eventually invested anyway. They simply paid much more to catch up. Today's leaders want to avoid repeating that mistake. Perhaps the most interesting part of this trend is that it extends far beyond technology. Healthcare providers are modernizing digital systems. Manufacturers are automating production. Retailers are improving logistics. Financial institutions are strengthening cybersecurity and cloud infrastructure. Transportation companies are expanding intelligent networks. Across industries, businesses are investing today for opportunities they expect tomorrow. That mindset marks a major shift in corporate strategy. Success is no longer determined only by what a company sells today. It's increasingly determined by what it prepares to deliver years from now. And that's why so many businesses are willing to spend billions before making a dollar. They're not investing for the economy as it exists today. They're investing for the economy they believe is coming next. Because in modern business, the companies that build the future first often have the best chance of leading it when everyone else finally arrives. And that's exactly why America's biggest companies are spending more money today than ever before, even when the biggest rewards may still be years away, may still